Lisa McCarthy with Out of the Box Technology.
Thank you, Bob. Okay, so I'm a co-founder of Out of the Box Technology. I'm going to talk really fast, so because we have a lot to get through. But I'm basically certified in everything QuickBooks. I've been working with it since it was DOS 1.0, so I go back to the very beginning. I'm on a lot of advisory councils for Intuit. We're also a member of the International Franchise Association, so we help franchise systems implement their chart of accounts and processes through QuickBooks. So we work with all products. We can get you discounts on buying QuickBooks. We'll extend our discounts on to you, so save you a little bit of money. So feel free to reach out to us if you are renewing your software. Okay. So we've done interviews with Google. We've been on case studies for Intuit, magazine cover stories. That's from the Franchise Relations or Franchise magazine. So we're very involved in our industry and in our space. What is our goal? Our goal is to streamline bookkeeping processes. So we work with business owners every day to figure out what's the best way to do things, what's the easiest way to do it to get from point A to point B. We also work really hard to integrate different technologies. In your space, you have ServiceTitan and FieldEdge and all these other applications that you use that need to integrate with QuickBooks. So we help with that process. All right, so there's basically 3 questions every business owner wants answered. First one is, how much money do I have? Or how much did I make? The next question is, where is it? Because it's not in my bank account. And then the third question is, how much am I going to owe in taxes? So all of these answers rely on good bookkeeping. So that is the root of everything. That's the starting place. So what is the difference between bookkeeping and accounting? Bookkeeping is the compilation of the data, putting things in, coding it, getting it in the right categories. Accounting is the analysis of the data. So you want to pay a bookkeeper to do bookkeeping and an accountant to do the higher level stuff, okay? All right, so what's the importance? Why is bookkeeping so important? Because everybody relies on those financial statements, your coaches, your advisors. You're protecting your investment when you track your accounting. It also provides information when you get ready to sell your business or transfer ownership. The first thing everybody wants to look at is the financials. The proof is in the pudding, in the numbers. It also, you have to do the necessary evil of filing your tax return. That's not fun, but it is one of the reasons we do our bookkeeping. Okay, so there's basically 2 accounting methods, cash and accrual basis. Cash basis is you only record revenue and expenses when they're paid. So even though you've incurred the expense, unless you paid for it, it doesn't count on your financial statements. A lot of people will run their books on cash because that's the way they do their tax return. I'm going to encourage you all to do your books on accrual basis. Accrual basis really tells the true picture. Cash basis only tells you if you're good or bad at hoarding funds, right? Because if you collect really well from your customers but you don't pay any of your bills, on cash basis, you're going to look really good. But on accrual, you could be losing money. So you want to manage your business on accrual, and a product like QuickBooks lets you flip back and forth between cash and accrual in the event that you prepare your taxes on a cash basis. So accrual means I'm going to pick up the revenue and the expenses when they're incurred. Doesn't matter if they're paid or not. If I put that bill in QuickBooks or I send that invoice out to a customer, I've earned the revenue and I've incurred the expense. Make sense?
Quick question.
Yes.
We're on accrual, but why would they even have a cash if accrual is better?
Because people file their tax returns on cash. It's an election. When you make your first tax return, you get to choose whether you're going to be on cash or accrual, and then you're kind of stuck with it unless you file for a change in accounting methods. So one is for tax purposes. The other is how you want to run your business on accrual. Okay, so we're going to talk about reporting on the financial condition of the business. There's 2 financial statements. There's the income statement and the balance sheet. So the income statement, this is the one everybody's very familiar with. How much did I bill my customers? What were my cost of goods sold? What were my expenses? That's all on the income statement. The other financial statement is the balance sheet. This is the one that most people struggle with and that they don't understand. So today, I hope by the time you all leave that you have a better understanding of both of these financial statements. So the balance sheet is what are all the assets that I own, all the liabilities that I have with vendors and credit cards and things like that, and then the difference between those two things is our equity. So let's start with a little deep dive on the income statement. So the income statement is an equation. I have income, subtract all my expenses, and the difference is profit. If I were to look at it in a graph, in a picture, if you're falling below zero, that yellow section is your profit, you're losing money. Okay, some people like to look at it in words, some people like to look at it in pictures. So this is what it looks like when you print it out of QuickBooks or another accounting software. Your revenue is at the top, all your expenses, and then your profit at the bottom. Hopefully it's a profit. There are a couple extra sections that we work really hard, like especially in the Service Nation Alliance and Service Roundtable, to establish a cost of goods sold section. You could just put everything in as an expense, but it's really important when you're analyzing, when you're doing more of the accounting side, to separate cost of goods sold from your overhead expenses, because that's going to give you a gross profit. And that gross profit, when you break it down into percentages, is going to help us figure out what your break-even point is. How much do I have to sell to cover my overhead? So you've got to be able to distinguish cost of goods sold from expenses. Cost of goods sold are the things that are directly related to your producing your revenue. So it's your job materials, your direct labor. It's not your administrative people back at the office or your office supplies. Those are overhead. You see the difference? Okay, good. And then at the bottom of the income statement, you'll often see what's called extraordinary income or other income and expenses. So what that is are things that happen that are outside the norm. Like let's say you have an insurance claim settlement where you got a big check because you had a fire in your building or something. That's not hopefully not part of your normal operating income, and so it's below the line. That's what they call it, below the line, right? So now let's talk about the balance sheet. The balance sheet is the hardest thing for business owners to understand, and it's really the reason why I created this class. It's basically an equation. Assets minus liabilities equal your equity. So let's talk a little bit about that. So your assets are the things that you own. Your cars, your bank account, your receivables, your furniture and fixtures, your land, your intangibles. Those are all things that you own that have a value, okay, that eventually you could sell off and get your money. Liabilities are the opposite of that. That's things that you owe, money that you owe back to your vendors, your credit cards, your banks. Maybe if you're the officer of the company, you owe that money back to yourself because you loaned a bunch of money into the company. That never happens, right? So it's your IOUs, it's your debt. So the difference between those two is your equity position in the company. So you want, obviously, positive equity, which means your assets have to be bigger than your liabilities to achieve that, okay? So now we're going to break down the balance sheet a little further. There are things that are considered current, and there are things that are considered long-term. So your current assets and liabilities are the things, in the case of an asset, are the things that you can turn into cash within a year. So your accounts receivable, hopefully your customers are going to pay you quickly, and so that will turn into cash. Or your inventory, right? You're going to sell that off, hopefully, in the next few months and turn that into cash. So those are things that are considered current. On the liability side, it would be your accounts payable. Most of your vendors aren't going to extend you credit for a year, right? You're going to owe them in 30 days or 60 days or 90 days. Your credit cards are things that you owe on all the time. Then there's long-term. So on the asset side, long-term assets are your fixed assets, your furniture and fixtures, your land, your intangibles. Like if you buy another company and part of that purchase price is considered goodwill or the customer list that you bought, that's a long-term asset that will stay on the books probably till you sell. Term liabilities are your bank notes, your vehicle loans, things that you're going to have to pay over the course of several years. Then the equity section, so we've got our assets minus our liabilities, and the difference is equity. So depending on how you're organized, your equity section will look different. So some of you are sole proprietor, one owner. Okay, so you'll have an owner capital and a draw. Some of you are partnerships, so that'll look a little different. And then a corporation is like an entity on its own. So you don't see partner, capital, and draw accounts. So this is what it looks like if you're in QuickBooks for each one of those, or an accounting software and print out a financial. So the corporation doesn't have any partner or individual equity accounts. It's just got stock and dividends and retained earnings. So the nomenclature is a little different in the chart of accounts depending on how you're organized. Okay, so it would be easy if the balance sheet looked like this. Assets minus liabilities equals owner's equity. But that's not, whoever invented accounting, they decided to make it even more confusing. So this is not how they present it on paper. So what I want you to do, how many of you are good in algebra? Oh, come on, somebody's got it. All right, so what happens if I want to solve for assets? If this were a math problem, what would I do? You'd add liabilities to both sides. And guess what? That's what the balance sheet looks like. When you see it on paper, that's the way it's presented. And that's why it's so confusing to people, because you look at it that way, and I'm like, I don't really understand that equation. So it is still the original equation that is understandable. It's just presented in a different way. So if we look at it on the screen, it's a balanced equation. So my total assets equal my total liabilities and equity. Okay? All right, so now we're going to talk about QuickBooks and accounting. And I know not all of you are on QuickBooks, and that's okay. It's just a tool. You could be on Peachtree, you could be on Great Plains, you could be on Successware, whatever you're on. But basically, your industry has unique reporting needs and requirements. You have to marry that with good bookkeeping and have a good tool like QuickBooks or other accounting package to help you get from point A to point B. So you need all 3 points of the triangle. Okay, so the starting point is the chart of accounts. It's going to vary by industry, and it's going to be organized by account type. So if you're part of Service Roundtable or Service Nation Alliance, this is a snapshot or just a little piece of the standardized chart of accounts. There's a very specific cost of goods sold section which will help you achieve your gross profit percentage. Okay, so let's see. Oh, then there's what's called a contra account. So within your chart of accounts, there are some accounts that are contra, meaning, as an example, in the income area, customer returns and allowances. That's considered a contra account. It's a negative income. It was income, it was a sale, but then they returned it and I had to give the money back. So it's considered a contra account. It's still in the income section, but it shows as a negative. Another example would be on the balance sheet, your fixed assets. You have depreciation, accumulated depreciation. That's considered a contra account. It's shown as a negative. Okay? Okay, so the two financial statements, the income statement is considered a temporary financial statement. Every year you get to wipe the slate clean and start over at zero, right? So you had a really bad year last year. This year you're starting out really great. You get to start at zero and go up from there. The balance sheet never goes away. That's going to follow you until the day you close your doors. That's why it's called a permanent statement. It's permanently going to follow you. So if it is a mess in QuickBooks, that mess is going to follow you forever until you get somebody to help you fix it and clean it up. Okay, so now you get to do something. I'm done with my lecture. You all have a name tag. Anybody not have a name tag? Okay, great. So there are 5 account categories. What I want you to do, look at your tag, and if you think you're on the balance sheet, I want you to get up and go to that side of the room. If you think you're on the income statement, I want you to go stand along this wall. Okay? And we're going to help you. If you make a mistake, it's not a problem. And you cannot sit there. No.
Say it again. It says fixture. Doesn't that mean I gotta stay here?
Take your best guess, and we will help you.
This is a balance sheet.
Balance sheet on this side, income statement over here. We need a sticker. Mary, where's Mary? We'll get you one. Dion, can you grab this gentleman? Okay, she's coming. This lady will get you a sticker.
Purchased or like inventory wise?
No, it's like purchased,
Okay.
like that you use on the job.
Okay.
Yep. Okay. All right. Let me look. You're fine.
I'm too.
You are not. You're coming with me. All right, so go over there. You need to go with him too, and so do you. Both of you. You're over there. Okay, let's see. Balance sheet over here. Income statement over here. You need to go too. Yeah, okay. No, you need to go over there too.
Okay, we got a question here.
Doesn't this depend on the price point?
Pretend it's a small price point.
Okay.
Okay?
Then I'm
So you're good. You're good. You're good. You're good. What's yours?
Oh, sorry.
That's okay. You're good. Good, good. Nope, nope. You got to go over there.
Okay.
Okay. You're
Vendor
good.
discounts. My guy falls.
What are you?
Vendor discounts.
Vendor discounts. Oh, you're a contra account. You're fine. You're fine. Let me see. You're good.
Sorry.
You're good. Everybody okay over there? You're good.
You got to be the sales guy.
Yeah,
All right. So I think we have everybody on the right side. Balance sheet accounts over. Anybody not understand why they are where they are? Because half the room was over here and I had to send them over here. Okay, so now what I want, now it's going to get harder. Okay, so on the balance sheet side, if you think you're an asset, go to the front of the room. If you think you're a liability, come in this section. If you think you're an equity account, go back here. Income accounts right up here. Expense accounts down here. Income up here, expenses down here.
I'm moving.
Are you having fun yet?
Yeah, I need help with agreement plans that are prepaid.
Okay, I can help you.
Income's up here, right?
Yep. Good. I'm too close. Sorry, I'm too close to the speaker. Sorry. You're good. Good.
Thank you.
You're good. You're in with the expenses.
Over here with us.
You're good. You're a contra. Okay.
Sorry.
You're good. You're good. Good. Remind me to tell you why I crossed out part of your sticker.
Okay.
There's a reason behind that. Okay, you guys all look good. Good, good, good. You You could go both ways.
But it depends on the
So-
balance sheet. So on my balance sheet,
All
I
right.
keep myself in the expense
Okay.
section
Okay.
as a counter to my.
So just so you know, what we were laughing about, this guy is vendor discounts. So he could be considered an income account, kind of, or a contra expense. So, all right, he's a contra expense today. Okay, I think you guys are all good. Yep, you're good. Good, good. Yep. Yep, great. Okay. So there were a couple people that had prepaid. So when you prepay something, that's an asset because you've already spent the money and you have a future benefit coming to you. If your customer prepays you, that's a liability because you owe them that service that they gave you money. So your maintenance contracts, you should be carrying a customer deposit or a, what's the terminology on your chart of accounts? I'm drawing a blank. Deferred income. Yes. Okay. So, all right. Now what we're going to do is I'm going to teach you a little bit about debits and credits. This is getting harder now. Okay. So, as an accounting student, I almost failed accounting when I first took it because I didn't realize I had to memorize this. So every section, every group of you has a normal account balance. So assets are normally a debit. So where's my assets? All you guys normally when you're trying to increase your assets, you would do it with a debit. Liabilities are a credit, equity's a credit, income's a credit, and expenses are a debit. There's no rhyme or reason. Credits aren't bad and debits are good. It doesn't work that way in accounting, okay? This is just something as an accounting student you have to memorize. I'm not going to make you memorize it, but now what I want you to do, if you think, and you can look at this chart, if you think you're normally a debit, go to the left side of the room. If you think you're normally a credit, go to the right side. Debits over here, credits over here. And I'm going to give you a hint. If I said you were a contra account, you're going to do the opposite.
So where did you say?
Well, what are you?
Asset.
So she's an asset. So normally it would be a debit, but you're a contra account, so you're a credit.
And on the balance sheet somewhere over here.
No, forget the balance sheet and income statement. That's gone. All right, so what happened to our income statement and balance sheet? It all mixed up, right? Everybody's in different spots now. Where are my helpers? Okay. Is everybody good over here? I'll do this side if you guys do that side. Okay, so let's see. Assets, debits, debit, credit. You guys are credits. Okay, sorry, I had to think through that. Prepaid insurance. No. That's a debit. You got to go over there. Okay, you guys are credits. Good. Credit, 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 credit. You're a contra. Customer returns and allowance. Well, normally an income account is, shoot, I'm too close to that thing. Normally an income account is a credit, but you're a contra, so you're a debit.
So that makes it a debit.
What are you? Deferred revenue service agreement. Yes, that is a credit.
I got these guys.
They're all good? Okay, great. All right, you guys are good. See? You learned a debit and a credit. Now it really gets fun. Okay. Guess what we're going to do now? We're going to get married. Okay? So, hold on, I got to get my prop. Okay. I'm going to put you to work. Pull something out of there.
And then pass it.
Nope, just hold on to it.
Do you want me to hold it?
And here, you take that. Okay, so there's going to be a bride and a groom, and we have to figure out which one of you is the bride and which one's the groom. The bride will be the credit, and the groom will be the debit. So the bride will have the flowers,
Okay.
and the groom will have the hat. Okay, so you write a check to pay for rent. Who's getting married?
Oh, the two accounts that are involved in this transaction.
You write a check to pay for rent. So what are you?
Building lease.
Yep, perfect. And where's? You write a check. What do you write your checks out of? Your bank account. Do we have any bank accounts around? Do we have a checking account? Did the checking account leave the room? He left with all the money.
It's like a real business.
All right, we'll pretend it's payroll checking since checking has disappeared. Okay. So they paid for the rent out of the payroll checking account. A little unusual, but that's okay. Okay, we'll do a transfer later, yes. Okay, so which one's the bride and which one's the groom? So the debit we said was the groom. So are we increasing rent or decreasing rent? Increasing rent because we're paying rent. So that's a debit. Do we have a wedding photographer? Deanne, would you take a quick pic? All right. Okay. All right, you're good. Thanks. Thank you for your participation. All right, we're going to do another one. Okay. Owner pays for his industry association dues using a personal debit card. Hint, it's a sole proprietorship. This is a hard one. So do we have industry dues? Okay. And if it's a sole proprietor, how does somebody put money into the company? What account is that? Equity. It's an equity account, and what's the name of it when it's a sole owner capital or equity? Do we have that account anywhere? Yay! Okay. Now we got two guys getting married. This is going to be fun. Okay. So,
Get the camera, Bill.
all right, so you're increasing and you're a credit, so you're the bride
Oh, look at that.
and you're the groom.
You look very in love.
Thank you.
Marriage counseling.
Okay, next one. Shareholder takes a cash distribution out of the business line of credit. That never happens. Shareholder takes a cash distribution out of the business line of credit.
Anybody have a line of credit?
Yep, that's you. Okay, so when a shareholder takes a distribute, and they're not going to pay it back. There's no intention to pay it back. So it's not shareholder loan.
Shareholder distribution.
Correct. Do we have that here? Awesome. Okay, so is the bank line of credit going up or down? No, it's going up because you just took money out. So that is normally a credit, and it's going up, so you're the bride. I have to talk through this because it's confusing. And if it's, okay. All right, thank you. Okay, we'll just do a couple more. Small tools are purchased on credit with the supplier. Okay, come on out. On credit with the supplier. What do you think that is? Yep. On credit with the supplier. What do you put your bills in when you're on it? Right. So where's accounts payable? Where's accounts payable? Ah, cool. Okay, so small tools is a debit. You are the bride. Oh, no, you're not. Sorry. We said the bride was a credit and you're a debit.
Thank you.
All right. It was actually more fun the other way, but.
All those over there are debits, aren't they? If they did it right.
Okay. Thank you. Next one. The bank deposits interest into the savings account. Bank deposits interest into the savings account. Yeah? All right? So the savings account is an asset, and it's going up. So you're a debit. So you're the groom.
I'm the groom.
Do we have interest income anywhere?
I'm interested.
Oh, you're interested. Do we have the savings? The savings ran off with the checking account. Oh, we got savings. Okay. All right. So you're the bride. Did I do it backwards? See, even I do stuff backwards. So the savings went up, so you're the debit. I'm sorry. I know you want to be a bride.
But if you hire Lisa, she'll do it correctly.
I will, I promise. I do better under pressure. Okay. A service tech takes money from the petty cash box to pay for shop supplies. A service tech takes money from the petty cash box to pay for shop supplies. So we got petty cash. So petty cash went down.
We have shop supplies?
Right? So petty cash is an asset, normally a debit, but it went down, so it's a credit. So you are the bride. Okay, we'll do one more. Okay, a new van is purchased via a loan. Vehicles, okay? All right. So our asset went up, so that's a debit, so you're the credit. All right, thank you. All right, you guys can all sit down. Thank you so much for participating. Yeah, we do have wedding favors on your way out. If you didn't stop by our booth and but you can't go yet. I'm not done with you.
15 minutes.
I'm doing good. Okay, so what are some bookkeeping best practices? Did someone say run out the door? Oh, the checking account ran out the door. Okay, so best practices are make sure you're using a really good chart of accounts because that's what's going to drive the financial statements. And we've got one established for your industry, so tap into those resources. Make sure you balance and record sales daily. Don't just wait till the end of the month and put in a big number. You're going to lose so much visibility into what's going on in your business. So you want to record sales every day. You want to reconcile your bank account. I've had clients, when I get a hold of them and I start with them and they've never reconciled their checkbook. So you got to do that. That's the first thing we do because most accounting transactions affect cash. And so if that's not reconciled, you have no idea if your books are accurate. That's why it's so important.
Just a quick question. New clients, what's the ratio what's a guess of they've rarely or never reconciled the bank account?
Well, some reconcile, but they just hit reconcile now, and then it forces a big adjustment. So that doesn't count. So then I would say maybe 10 to 15%. Reconcile your credit card accounts. So you guys probably make a ton of purchases using credit cards. Make sure you're reconciling that every single month. Match your or watch your accounts receivable. So if your aging gets way out there too far, the chances of you being able to collect on that receivable go down. Right? So make sure you keep an eye on those open receivables. Pay your bills on time. Okay? Because if you start to get behind, it's just going to get worse and worse and worse. So, don't commingle personal into your business. This is the biggest mistake I see people do. And the problem with that is when you go to sell your business, you've overinflated your expenses and it doesn't look so good. So don't do that. And close your books. At a minimum, you need to do it once a year. Make sure you close your books once a year. Okay, so these are some standard reports in QuickBooks, and most every accounting software has these same kind of reports to help you with your month-end close. So some of the things I look for when I'm looking at people's books are, does accounts receivable look okay? Is there a bunch of unapplied stuff hanging out all over the place, or stuff that's 10 years old that needs to be written off? Okay, so I go through accounts receivable and get that cleaned up. On the payable side, is there balances that are really old, or are there unapplied payments because someone wrote a check and didn't necessarily do it right and didn't apply it against the bill? You could overpay your vendors if you don't keep a close eye on that. This is a picture of the bank reconciliation. So what I look for on the bank reconciliation is, what are those uncleared? I've already matched everything on the bank, so I'm good there. But what are the things that didn't clear? Do they make sense? And I know it's a little blurry, I'm sorry. What are the things that haven't cleared? Is it a check from last month? Well, that's fine. It'll probably clear in the next 30 days. But is it a deposit from 6 months ago? Do you think that's ever going to clear the bank if it's still sitting there? No. So did somebody double record something? And you think you have more cash than you really do. So doing the bank rec is a really, really important function. When you're looking at the income statement, one of the things you want to do is add the percent of income column. That will allow you to establish your gross profit percent and establish a break even. Really important. With a click of a button, you can add that column to your financial. The balance sheet, what do I look for there? Well, make sure the assets equal the liabilities and equity. Make sure it's balanced. If it's not, and you happen to be on QuickBooks, there could be a little bit of corruption in your file and you need to run a verify or rebuild. If you add the prior period or the prior year column to the financial, you can see, how's my cash this year versus last year at this time? Or how's my receivables this year versus last year? And then make sure you close your books. Every year, when you give the stuff to the accountant to do the tax return, lock it down. So if you only do it once a year, your accountant will be very happy. Otherwise, you keep changing things, and they've already done the tax return, and they get really frustrated. So the minute you give it to the accountant, close it. Lock it down so you don't accidentally change something. You can always override that if you know the password, but lock it down. Okay, a little bit of deep dive into some of these things. So if you are in the contracting space, a lot of times you do estimates and you want to compare your estimate versus actual. How did I think I was going to do on this job versus how did I actually do? In the Service Nation Alliance template that we came up with, we have different areas that we want to focus on. So within the HVAC space, we want to be able to get a gross profit on new installs versus my maintenance agreements versus repairs. In plumbing, similar. In electrical, similar. All right, so these are all important numbers to be able to review. Commercial and residential, that's another way that people want to slice and dice in your space. How much am I doing? And we added a third one, new homes. I think new construction. So those are different types of customers that you're dealing with that you want to see which one's most profitable. Where should I be spending my marketing dollars? And then trend analysis. So there's both horizontal and vertical trend analysis. So horizontal is when you look at period over period. How did I do this year versus last year? And then vertical is where you convert everything as a percent of income. And there's targets where you can say, rent should only be 10% or whatever. I don't know what those numbers are in your space, but that information's out there and you can kind of measure yourself when you break it all into percentages. Okay? And then QuickBooks has all kinds of dashboards. If you're on QuickBooks Online or desktop, you can build out your own dashboards. So that's all I have for you today. You did really good. You graduated. Couple things. I do have a book that goes along with this class that if you're interested, I can ship it to you. I have order forms in the back of the room. My card is back there. We have parting gifts for you. If you didn't stop by our booth, we have flasks, because I know you're in Vegas and everyone wants to drink. We also have something to put in the flask if you'd like. So you can grab that on your way out.